The S&P is basically, you had this gap up on 3-1, and it was on some news, and obviously on Trump news, and you've had a sell-off for the most part ever since. It's been very begrudging and slow, and it's not really like a sell-off with gusto. I think there's a lot of media that's trying to attribute like geopolitical issues to why there's the sell-off. That's not really what I'm seeing. My take on it is that we had a poor high that day, and we've just had a continued liquidation break ever since. I think that you have a lot of traders who are trying to de-risk ahead of a few big events. You have the debt ceiling, I believe that's March 15th, 16th. You have the jobs number tomorrow, and then the Fed is next week as well. The probability of a Fed hike is going to be, it's oddly right on the debt ceiling day. The Fed is the 15th, and you have like a 90% probability here of the hike. So I had said for a while that I thought that the probability of a hike would increase as we got closer to the meeting, that the market had overly discounted the fact that there would be a hike, and I didn't necessarily think that we would have a hike, but I thought the probability of a hike would increase. At this point, I'm starting to think that the probability of a hike is likely. You've had the market rather high, and I see a few instruments behaving as if a rate hike is coming. So with regard to the S&P, you had a touch basically to the tick on the 20 MA, and then a decent rally. Still below the 10-day. I've said for a while I thought at the very least we would see a pullback to the backside of the up channel. We were trading on top of it. If that were to come down, like let's say tomorrow, you'd be basically 234 half-ish, I want to say. That's roughly around where that would be. And I've said that if there's a larger pickup in a correction, that I think we could see a 50-day moving average test, which would likely be a buy, at least the first go round. So you have a hammer range today. I like the extremes of that range as a kind of a go with. So if you got over today's high of day tomorrow, and particularly if you got through 237.77, those were the 2 days that had the closes below the 10 MA. I think we would see a rally up. I don't know necessarily that we would see a new all-time high, but at the very least, I think we would see some type of a lower high. I had done a poll. Some interesting question. I use the simple moving average. I'm a simple man. I use simple moving averages. I keep it simple like that. I had a poll that I conducted today before the close, and it was basically, are we going to rally or dump tomorrow on the jobs number? I'm a little disappointed that the outlook, the response rate here is only about 80 votes, so I can't really make generalizations over that. I usually like when it's in at least a few hundred. But right now it's about 70-30 roughly, rally versus dump. So my thinking is this, is the best setup for the Fed, honestly, would be a dump tomorrow, some type of panic Monday, Tuesday, and then you get the move up. You'd have shaken out a lot of the weak hand chasers. You'd have sucked in a lot of new shorts. And I think that that would set up, after multiple days down, you'd have then had 1, 2, 3, 4, 5, 6, 7, 8 to 9 days of straight down. And I think that that would basically set the table for some type of a rally up on the Fed. If we are to rally ahead of the Fed, into the Fed, then I think the probability of a dump on the Fed gets a lot higher. It shouldn't be a surprise that there is going to be a rate hike, though, next week. It seems like that is going to be in the cards. A couple of things that kind of caught my eye. First of all, oil is coming down. Oil going lower is a deflationary tool, and we know the Fed has not yet reached their inflation 2% mandate. I know from past discussions by Janet Yellen that she had talked about symmetry, meaning that inflation has been below 2% for so long that they would be willing to tolerate more inflation than 2% to kind of compensate. I don't know how that's going to play out. This was on 4/12 of last year. There had been a rather steep decline. Oh no, I'm sorry, it wasn't 4/12. The day in question was 3/29. That was the day I had been thinking that the rally up in the market was going to be an opportunity to short. And that day, when I heard Yellen, I flipped and went back bullish. I had been playing long off the double bottom, the W pattern, and was looking for an opportunity for a short at the gap fill. But once I heard Yellen, I started flipping and singing a different tune back to bullish, because she basically said, "I'm sorry, I'll never do it again," and became very dovish. Anyway, we don't have 2%. The couple of things that we need to be on the lookout for here is oil, first and foremost. I'm going to get into that in a minute, and the prices that I see as important. My theory, my kind of conspiracy theory with oil, and I actually heard someone mention this on TV today for the first time. I guess they're starting to watch my broadcast, that you have the Saudis bringing Aramco public, and I think that they want to keep the price high so that they can get that IPO done. So I can't really see, I don't really think you're going to have a huge correction in oil. While we're talking about it, I think the likelihood of a pullback here, 49s to me is important. I'm going to mention, I'll just do this quickly because we're talking about it and it's very easy to discuss. Today we had the 200-day moving average test and held. It was also the 50% fib of the range from the double bottom low. And we had a close today. What was the close? Just above the range low of 49.61. It had been higher than that. It may actually even be higher than that in 49.62. So we closed just above it. So technically today was a look below and fail, and a hold of the range. If we were to get back up above, let's say today's high tomorrow or the next day, which was 50.84, I think we'd likely rally to the kind of the major breakdown point, which was the 50% retracement of the entire range, which would be about 51.81. Another thing to consider, I know that a lot of people are discussing about what to look for in the Fed, and my kind of thinking and what we need to look for is if the Fed they had said this year that they were looking to hike 3 times, and I had said I thought we would see 2 to maybe 3 max. I still think that that is the case. But the street is starting to talk about 3 to 4 hikes. If they hint at 3 to 4 hikes and not 2 to 3, it could be an issue. Why do I think that they'll only go 3 times max? I think this summer that there's going to be some geopolitical headwinds with Chancellor Merkel maybe not being reelected, and potentially an upset and a bit of a panic in the French elections. Everyone seems to get so nervous about these nationalistic candidates, like with Brexit, with Trump, now with Marie Le Pen. And then they wind up being pro-growth, and the markets slough it off, and they go higher anyway. So I'm also looking in the jobs number tomorrow, and this is going to be the key. The headline number, of course, is important, and we had this really big blowout in the private payrolls yesterday, and I think that's what's caused the sort of the repricing in bonds. But I want to see what the wage growth is like. Wage growth, if there's a lot of it, could start becoming a little bit inflationary. What amazes me is how excited everyone is getting about the idea of a little bit of wage growth being inflationary. A little inflation, I think, would be healthy at this point because we've had deflation for so long. You've been sucking wind with crap jobs for years. anyone who's been watching me for a while, I have, I mean, it's sort of, I say it tongue in cheek, but carnival ride operators, I'm saying, are like the new doctors and lawyers, because the jobs are kind of drying up, and there hasn't been wage growth in so long. It's been like these 0.1 upticks. And as hopped up as everyone is about growth coming in the future, and I do think it's coming down the pipe, that there is room for error here, and we only have a 1.3% GDP number from the Atlanta Fed. So I think it would really do the Fed service by being a little bit more conservative in their rhetoric here. So that being said, the scoop of the oil is going to be interesting to me also. I want to see what they have to say if they address it in the minutes. The last minutes, the Fed was saying how oil was improving, and now it's not. It's going down. So I'm curious to see how they tackle oil, because that's a deflationary issue as well. With regard to oil, I see a good right-out trade here. Long above the high today, which was 50.84, or short below the low, which was 48.59. And my targets on the downside then would be 47.22 and roughly about 45, which is kind of my terminal price here, somewhere between 44.99 and 45.32. That's like the 61.8 and the 78.6 of both time frames. It's also the channel low, and it's a big reference volume node. So I think sort of 45, in my view, would be kind of the worst of it, because we're coming down from the top. I know a lot of people think, I've seen some projections today about people talking about 42. Maybe, but it seems to me like that area would be more my target. As long as we hold above 49.61, the potential for repair is there. So I'm just throwing that out there. We basically held the 200 MA today. The last two times we've come down, moves below the 200 MA have been unsustainable. So that's just my thinking here. Today's range is going to be key, long above or short below. A couple of breadcrumbs that I see out here. The first and foremost one is Exxon. Exxon started showing a lot of weakness ahead of oil, and it should be showing strength ahead of a recovery, which it started to do. Even yesterday, in kind of the depths of the move in Exxon, it didn't take out the range low. Today, you actually had a look above and a look below and fail, and then a move back into range. So if you were to get back up over the false break, like let's say this was a false breakdown, 82.38, I think Exxon would probably have a run to at least the 50 MA. Yesterday, like I said, yesterday was starting to show some relative strength, and today was confirmation. Even when oil was kind of on the lows of the day, Exxon was either flat or green. So that to me was a big tell. What else did we want to talk about? Let's get into some of the metals. I know there's a lot of concern about the metals. So what I see here is gold basically got up to roughly close to the 200 MA and now pulling back. You're below the 100 and the 50. If there were to be some kind of like a quick spike down tomorrow in GLD to like 112s, I'd probably be looking to sell some out of the money puts. Either take the shares somewhere between that 112.12 or like 110.86. There's a gap fill there, but I'm really looking more at the 61.8, which is that 112.12. So I'd be interested in either shares there or a near dated out of the money put sale on any spike down there after multiple days down. I think it's exhausting itself. My preference in the metals is silver. I had been looking for a bit of a pullback, and now we got it. The 61.8 of the last range is roughly 15.87. There's a reference, strong reversal bar right around there. The low there was 15.85. So in this area, I'm starting to get the itch to sell some out of the money puts. The big pattern in silver had flipped, and we had broken out, and now it seems like it's kind of failing back lower, but I don't know how far that's going to really pan out, so we'll have to see. but I am looking for a bounce play there in silver. The GDX, which is the gold, really the gold miners, right? Also at some key levels here. We're right into the shorter term 61.8. The bigger 61.8 comes into play really around 1981. So if there's a move down into that region, I'd probably be looking to kind of try to buy the dip or sell some out of the money puts. We're still in a bit of a downtrend here, and I guess I can't rule this thing going back down to like the 15s, where I would be a very aggressive buyer. But I do think for a right or right out play, that area would make some sense to me for at the very least a bounce. Let's get into one of the big concerns I'm starting to see. HYG today actually broke and closed below the channel low with a failed bounce up to the 100 MA. And you have a 200 MA right below. So what am I thinking about with HYG? HYG is the high yield, and if this is also something the Fed should pay attention to. I don't think that we're going into any type of a credit crisis here, far from it, but I do think that there is some type of a repricing here of risk, given the fact that the Fed may start getting a little bit more aggressive with interest rate hikes. I like today's range playing against it. Above it would be to me a look below and fail and a long back to the upside, but below, I'm thinking this thing could see like 85.20 maybe. That's the 61.8 of the entire range. The 50% fib is around 85.81, and we're coming down to it basically. How I see it is we had a look above range that kind of failed. It was a multiple day look above range, and now it's coming back in. So I think usually what happens when you look above a range, you come back down to the very bottom of it, which would mean like 83s. I don't know if that's going to be the case, although the ideal scenario here, of course, would be it to come in a straight line, and then that would be a screaming buy considering it came from the top. But I do think that at the very least, the midpoints of the range would be important, and I think that the neckline kind of breakout was around that area of the inverse head and shoulders. It's actually right around where we are here at the 200 MA. So I do think somewhere between the 200 MA and the 50% fib, there should be some muscle memory, and I'd be looking near dated to sell some out of the money puts there because I don't think it's going to just be a complete collapse. But this is something to be noteworthy of. You know, when you had the larger correction, some of the bigger corrections last year, it was because of HYG collapsing and oil collapsing at the same time. And the risk here, of course, is a little bit of history repeating. So I'm paying very close attention to that. Like I said, above the high of day today, if you're playing short, has to be a stop in my view, or a right or right out long for at least a bounce, probably to the 50 MA. So I'm keeping an eye on these things. These are early warning signs of potential trouble for the market. Another early warning sign, and I was keeping my eye out for this, would be Apple. Apple led the rally, and it's had a lot of notable weakness. It hasn't really broken down here, but you kind of had a bit of a flag forming, and now it seems like it tried to break below. I don't know if this is going to be a look below and fail, but I'll say this. Anything below 37.60 to me is vulnerable. If you want to extend that out to today's low, was 37.05. Anything over 140.28, the thing should scream back up to the upside, and it could be a resumption to the blow-off. My view is that we got it on the wrong side of the channel here. We're trading above it, and it's trying to correct to retest the backside of the old channel, which would be currently around the 130, high 131s. So to me, that would still be a fairly Apple would still be healthy if it pulled back there and was able to hold. Usually what happens with the channel is you pull back to the backside of it, it bounces to usually a lower high, and then it has the pullback. So if you're looking to kind of short Apple, you'd probably want to see the pullback there, the bounce, and then the subsequent move lower. I have been bullish on Apple. I'm starting to be a little cautious, though, going into the summer months. Those are the slow months for Apple. and I can't imagine their phone getting a lot of bids to it or people buying ahead of the launch of the new phone, right? The 8 is supposed to be the big deal. So while I'm bullish on Apple, they probably are going to have a couple of quarters coming up that are going to suck a little bit of wind. There's some rumors that there might be some kind of an event, an unannounced event with Apple. We'll have to see how that plays out. If that does happen, there could be a change in that pattern. As far as where I'm looking at Apple, it still hasn't broken the trend. I'm sorry, I'm just don't have my drawing tools here. Now I do. Let's see if you connect these lows. I mean, I would be interested in seeing this pull back, I mean, to a 50 MA test, which to me, if that could coincide, like if Apple could kind of just stumble along here and that would coincide with the backside of the old channel, would be even better. The 50 MA is moving up rather quickly, but it isn't quite there yet. It's still down in like the 127, so we'll see how that plays out. But a little early weakness in Apple to me is something to pay attention to. I think you could use today's range as a key. If you take out the low, it's a short. Above the high, you could try adding long. And then if you were to take out the 140.28, to me would be a still further long. One of those kind of if this then that plays I was talking about late in the day today was Ulta, the Ulta salons. They reported earnings. And as I suspected, kind of they were down. The setup, though, I don't think was to be short for the earnings. When you have a look above range, it tends to, it held the 50 MA, so it was sort of a no-go here. But when you have a look above and fail, it usually winds up going lower. My thinking on that is because we did look above range and fail, this may want to come down to the lower end of range, which is around 244.75. That was kind of that big candles extremes. But I'm thinking that this would maybe at the very least see the 100 MA. It's pretty close to there, or the 200. What I'd probably be looking to do tomorrow or in the coming days on any bounces, sell some out of the money calls or call spreads, and maybe even fund put spreads or put ratios, because I do think that this is probably coming down now, considering it had the look above and fail and now is down on earnings and through the 50 MA. So the 50 MA was support, it should be resistance now. The IBB, something I've been watching for a while. This is really choppy. I got stopped out of the Gilead trade. I had taken profits on it at the, I had discussed this in the 70s. I was trying to hold for 73s, but wound up getting stopped out. A little frustrated because yesterday it had that big bounce. And I'm glad I didn't get back in. I wanted to see how that played, and I talked about that being a long or a short based on yesterday's range, and it wound up being the short today, which worked out fine. IBB is basically up at the top of the range here. It had a bit of a look above and fail here, but it's not really backing off a lot. I think that unfortunately, it's in a channel, and like 309s, there's an old gap fill at 306s, and then like 309 and change-ish is the, almost 310 is the channel high, and then like if you were to like do some doubling up of the range, you'd be at like 315. So I'm kind of an interested buyer of this on dips into like the lower end of the range, like 200 MA or below on pullbacks, like to sell out of the money puts, because I do think this thing is just going to be choppy for a while. But I don't necessarily know if I want to first initiate and chase here to the upside. But if you could get back up above that high, there could be a quick trade for like a quick 5 points. The dollar, I'm sorry I didn't get into this actually earlier. This is really going to be a big deal in the coming days here. The dollar, I had said, was setting up for a head and shoulders pattern, and it still is. The problem is it's hanging out here and building out a lot of time, and if you were to get through this right shoulder high here of 102.27, this could really shoot up to the 103s and really start invalidating the pattern. And if the Fed starts getting very hawkish here, we're going to have a problem. And this could be this could, everyone's talking about what could cause the larger correction in the market, and it could be the dollar. Because if you start taking out the highs of those 103.82-ish, basically, 103.81 half, the measured move of the 2 times range is close to 109. That would not play out well in the markets. And, I'm trying to think about the Fed here. They've mentioned the dollar, and they're concerned about the strong dollar. So that is going to also be a key to look out for in the press conference and the Fed minutes. Something I'm considering that I don't necessarily know a lot of people if they're considering, but I'm going to lay it out there for you, and this could be one of these scenarios here for a dangerous event. President Trump was very critical of the Fed during the election process, and Janet Yellen is a big-time Democrat and was a Hillary supporter, as was Lael Brainerd, who contributed to Clinton's campaign. She was also President Bill Clinton's rep to the G9, and it was revealed in some leaked documents that she was on the short list to be Treasury Secretary. Brainerd had been a very dovish member of the Fed and was starting to step up with prominence. And if you take a look back on my feed, I had said if Hillary won, I thought she was going to be my pick, that she would pick her for the Treasury Secretary. I don't know if this is going to be the case, but there's going to be a lot of turnover in the Fed soon. And maybe there's some political retribution. Maybe the Fed wants to burn the president. So it wouldn't be the first time in history this has happened either. I don't want to get back into. I don't want to get too into this, but Andrew Jackson had been very anti the central bank. He was almost assassinated as a result. Actually, a lot of people don't know this, but Jackson could have been in a lot of trouble. The guns stalled. As crazy as that sounds. I know a lot about American history. I took AP American history in high school and had college credits or whatever, but let's not get into that here. So the story with that is there could be some political retribution in there. So I would not put that past the Fed. There's like this hysteria in liberal lands, so very possible. The bonds. Today, we saw the breakdown in the bonds. I don't know if this is going to be a look below and fail situation, but I've been looking for this thing to get a trend line touch, which is basically a double bottom, sort of like in the 115.44s area. What I'd love to see for this thing to do would be to go into the Fed on like some kind of panic move and get really steep down and set up for an opportunity for a risk reversal, or maybe it comes down and then breaks hard on the Fed and then reverses. Fed hikes tend to be the lows in a cycle, and then there tends to be a bounce. That would be my play with this. I'd love to see this really start getting steep into the Fed and people getting panicked out. And then I'm going to be looking for some type of a relief rally in the bonds. So short term, I'm a little cautious. We really are kind of getting close to the lower end of the range. But the best setup for a trade here would be to have weakness ahead into the Fed. I think the fact that the bonds are pulling back has been what's putting pressure on this situation here with HYG. The riskier of the bonds tend to get, into trouble when the kind of their benchmark gets smacked. Again, I'm just pulling out the Fibonacci retracement here. HYG had a really big run from 75 all the way up here to 88.37. In a bigger picture, a 50% pullback could take you to 81s and the 61.8 even down to 80s. I don't know if that's going to be the case. There's a reference low around the 83s, which is the 38.2 of the move. I don't really use 38.2s as a gauge, but like I said, that area to me, 83s, will be very critical. And the fact that we have a bit of a trend snap here tells me that it's possible that we do get somewhere between the 83s and 84s. So when we get down if and when we do get down into these 85s, and I'm not saying we will, because the 200 MA was a very key level. If that holds, this could just be a blip. But if we start getting into there, I'm looking to sell some out of the money puts for at least a short-term bounce, because I do think that that range will hold. And no, I don't think we're in the midst of the throes of a credit crisis. I think I'm going to end it there, keep it a little bit shorter today. So what I'm looking for to kind of button this, let me talk about Boeing quickly. So I laid out my trade in Boeing in the weekend review video. Man, this thing has been pulling teeth to get lower, right? So yesterday, I should have waited till today, but I just wanted to get it kind of on my done list just because this thing has been so not cooperative. I still have it on, half of it. I took half of it off today, actually on the dead lows, and I tweeted that in real time. I had sold at the time put calls of 185s expiring this week, naked calls, to finance a put ratio for, an even put spread for next week, 180, 175, and I'd put that on for a 25-cent credit. I closed those calls and paid 10 cents, so it's really now a 35-cent debit. This has been a pretty big home run here. I closed those, like I said, I closed those calls basically for peanuts. And now I closed one of the put spreads for a pretty tidy gain. It unfortunately in TOS doesn't show the P&L once it's closed. It kind of goes away, but it was pretty solid. I closed one of those for like $1.35 on the lows today. I'm kind of so what am I looking for here? Here's the scoop. Today was a kind of a breakdown day. You looked below the low, but still closed inside the range. The low of the range was 180.43 before the bounce. Today's close was 180.57. So I'm on guard here. If we were to get like above the 10-day tomorrow, I'll tell you, I'll be stopped out of this whole thing above 182.59. It really should not go back up above there, and I would honestly be very cautious if we got even above 181.93. It really should not be back up above there again. We should be in a beeline down to the backside of the old channel, which is around the 177s, and close, maybe even close to the 20 MA, which is 175.95. It may bounce tomorrow, just because this is how this stock is acting. It's very strong. Very often people don't realize the end is here in these stocks. It's really, honestly, very extended. It's due for a pullback. It's had a lot of topping action. It would be a wonder if this were to like have some kind of gap down tomorrow. Maybe there's a downgrade or some news, but it may take to next week. So we'll have to see. But if this starts again, like I said, getting back up above the 181.93, which was another topping tail, I'll start not being happy. Things won't be well in JP land here. So I'm glad I was able to cover and tweet it in real time, basically near the dead lows, that we covered half of it today. And why was that? Let me explain why. We were into some reference levels in ES. For me, it's an amalgam of events, and we were basically into the lows. I was seeing excess in the ES on the lows. We had an excess low today, which also augurs well. If there's a gap up over today's high, there could be a squeeze higher. That would be very dangerous in my view ahead of the Fed. If there's like a rally today and like if it continued next week and there's no pullback into the Fed and we're basically on highs, that could either work out two ways. One, there's some kind of big gap up on the Fed and we really do get the big blow off, which no one would be expecting. Or there's a pullback on the Fed after people are sucked back in. I'll comment a little bit more about what that would look like and how I would play it in the weekend video. So let me table that. I'm going to be a bit of a tease on that for now. We do have excess on the low today, so I will say this. If we do lose today's low on the jobs number or on the Fed, it's a great short entry. Mark that down, but there is excess. So why did I cover the Boeing? And actually make some other trades, but I didn't tweet about all of them, so I don't want to really discuss them and try and take credit for things that, listen, I have the money, right? So it's good enough. But you can only do so much. I really need like an intern, for someone to like sit by me, do the, like, I dictated and did, maybe I just bought that Alexa thing, so maybe that could tweet, right? I could start like speaking my tweets to Alexa. That would be great. I'm gonna try and set that up this weekend. Anyway, I was seeing excess on the lows, and there was no volume. Like, there was no volume in that move down. It was very obvious to the initiative, right? The initiated here. Theatricality and deception is powerful agents to the uninitiated, but we are initiated, aren't we, Bruce? And I just saw that this was not a real move. It was an algorithmic move. We're running stops late in the day, and it was just obvious to me that there was going to be a rally back to the VWAP, and it wound up being even stronger than I thought. I was only thinking to VWAP, but it wound up being up. So that was also why I had covered the Boeing. I was waiting for the break. I got my opportunity. It was an artificial move lower in the overall market, and I took the opportunity to cover. Often I do that on situations when there's news or some kind of artificiality in the move. By the way, that was a Batman Dark Knight Rises quote. I often quote movies. Anyway, I think we're walking the fine line between mania here and insanity. If anyone knows where that comes from, by the way, you will be like FF forever on my view. That's a deep quote from another one of my childhood fans, being a fan of an industry. Anyway, so that to me is going to be key. Boeing, so anyway, to wrap it up with Boeing, below today's low, I would probably add to the short again. I'd add back to it for the move lower. Above the high is, to me, a clear look below and fail stop out, and you don't want to be short, and you'd probably actually even want to play long for a move back up, at least close to the old all-time high. So that's my view on that. I will get a little bit more detailed about how I think things will go with the Fed in the weekend review on Sunday. So I hope this video was instrumental. If you missed any of it, there will be it's on my YouTube channel, so you can watch it again. Anyhow, click the plus button. There's like a plus with a bell for my. First of all, subscribe to my YouTube channel, and hit the plus with the bell, and then you'll get notifications when I go live, and you'll get, by the way, I don't post like pet video. Anything that I post on this channel is trading related, and you'll get a notification when it's posted. So that's the scoop. If you like the video, be sure to give it a thumbs up. Please leave some comments. Your comments help me make my videos better. The best form of thank you is a favorite and a retweet, particularly on Twitter. So let's have a great rest of our trading week. I will do more updates on some of the stuff we had covered, particularly the Boeing trade in the weekend review video. Have a great rest of our week, and cheers.